Hello everybody, and thanks for joining us today on our multi-asset webinar. My name is Murray Anderson. I'll be your host for this webinar. On my left is Romelon Chetty, who's in our equities team as a portfolio manager. Bastian Teichgreeber, our CIO, and on his left-hand side, Shriya, who's a portfolio manager in our multi-asset team. Bastian, lots to talk about as usual. And first of all, I think to start things off, we need to look back in the past quarter. A lot happened. Just give us a little bit of a reflection on what took place, because it was tumultuous given what we'd seen from the American markets.
Yeah, Murray, you're right. Thanks first of all, everyone, for joining once again. But I guess, a lot has happened, and a lot of it was linked to tariffs. So we're forced to jump into just speaking about tariffs. I guess there's much more which has happened, but I guess it is the right topic to focus on. We started the Trump presidency on a positive footnote with the expectations of lower tax rates, potentially productivity gain through more investments, fixed investments, particularly mentioned the technology sector here. And we also spoke about deregulation, but all of that has basically been lost in translation, and it's not part of the conversation anymore. Now we're talking about tariffs, now we're talking about tighter border controls, and that's what takes center stage, and that's obviously very bad for businesses, very bad for the consumer because it creates uncertainty, and then also not good for the investor because as an investor you want certainty as well.
So you mentioned sort of the stock market did extremely well, and then it kind of hit into panic once the tariffs came in, and particularly Mag 7 started to come off in the early parts of sort of the tariff announcements. What are that from an economic perspective? How do we measure that, and what do you look at?
Yeah, panic is a good word, I think, because if you look at what happened to equity market, they were quite quick to fall quite deep, and came back a little bit after that. And if you look at the VIX, basically the fear gauge, which basically can gauge exactly how much the market is in panic, that spiked to a level which has last seen only during COVID or the great financial crisis. So panic is exactly the right word. But the problem with that panic is it also impacts the real economy eventually through a loss in business confidence, loss in consumer confidence, and the US economy being so consumption-led, then obviously any uncertainty creates a lot of problems. Okay, so we start with a top-down view of the US economy, the way we capture it in the Prescient economic indicator. That's our own in-house nowcasting, which we always showcase, because it does tell us where the US economy moves in real time. And what I mentioned earlier, that the US economy is so consumptionist, leads us to look into consumer confidence. And there's a lot of surveys which we can basically use to basically tell us what's going on there. And one of them is, for example, the Michigan Household Study, a consumer sentiment survey. And that one basically tells us pretty much in real time how the consumer is feeling. And if we look at these data points there over the last couple of weeks, they've been incredibly poor. In fact, the last two data points have been the worst since a long time. So that's an important one. But to counter that, then we can also look into the labor market. The labor market kept on coming strong. So that speaks to that whole conundrum of we have a very weak soft data and we have very strong hard data. Normally the hard data tends to follow the soft data, but maybe the soft data turns before the hard data starts to deteriorate. And we don't know that yet, but that's what could have happened if Trump keeps on basically turning the tariff story around into a more positive story now again, which is what we see these days. What does all of this mean for our estimate on real growth? So on this chart, we're showing the Prescient economic indicator. And if we just zoom in a little bit and focus on the last couple of data points, you can see in the dark blue line, the estimate that basically, the light green line, that's a Prescient economic indicator. So the estimate, dark blue line, is the real GDP through time as it has printed. And on the very right-hand side, you can see that there is quite a bit of a slowdown, but it's very choppy data. And that's basically exactly that conundrum of ever weaker soft data, ever stronger hard data, and very big discrepancies thereof. And that means that the estimate jumps around quite daily. But the reality is if we look into the detail, we can see that the last print points to a 1% real growth. That's not amazing, that's not terrible. So our point here is, yes, the economy is slowing quite significantly based on the poor soft data, but it's not falling off a cliff yet, and we need to observe what happens to that soft data because Trump might well turn it around.
Thanks for that view, Bastian. If the US market or the economy is slowing and we expect US growth to be poorer, what impact does it have on global economic growth?
Yeah, we always focus on US growth because, not that we can't track global growth, but we can track US growth quite well because of the frequency of data and the reliability of the data. And we do know that US growth is the engine room of the world. So with less US growth, we will have less global growth. So that's why we focus so much on US growth. And there we see a slowdown. So to answer your question, slower US growth certainly means less or slower global growth. And that's what obviously is quite negative for risky assets. As said, things are not falling off a cliff. It's not all that terrible. We've been through many recessions before. The market is partly priced for some of these already. But definitely from a top-down point of view, the economic picture is not looking too rosy.
Thanks, Bastian. And you mentioned Trump tariffs, and hopefully, certainly what we've seen from this weekend, it's not looking as bad as initially expected. I guess he throws out the big numbers and then claws back and pulls back. So, hopefully we see a little bit more of a further turnaround on the PEI, and the numbers look a little bit better in the weeks and days to come. Shriya, turning to you in the multi-asset team. I mean, obviously, given all of this, you've got to consider multi-asset classes and how to combine all of that into a portfolio. Give us a view on the spectrum of asset classes at your disposal for building a balanced portfolio.
Thanks, Murray. I think Bastian put it quite nicely. There's been so much volatility that's played out over the past couple of months. If we were standing in December, who would have known that asset classes would have performed the way they did? You came out, or you started the year feeling very positive about growth, feeling very positive about the idea of US exceptionalism. So having US equities underperform, having a year, well, at least year to date for emerging markets, I mean, it's been great. But also seeing things that we, didn't typically expect, like US bonds acting like risky assets, weak dollar. So a lot has transpired, and we can obviously appreciate that, but we can't assume that that's going to happen going forward. And so what we try our best to do when we develop our asset class views is look at a various amount of indicators around the world, and we'll look at things like valuation, sentiment, economic growth, to actually get quite a good holistic picture of asset classes on a forward-looking basis, because asset classes, or at least markets, are forward-looking. And so we do this on a daily basis. The data comes in, feeds into our models, and it updates our views, and that ensures that we stay relevant and we stay at the forefront of any new data that's being released. So let's have a look at where we were at the start of the year and see what's changed. So looking at January 2025, this is essentially how we were positioned. You can see that we've got lots of neutrals across asset classes and across geographies, but you can also see that there were little pockets of opportunities. So this is essentially in the South African space and in some parts of the emerging market. So SA equities at the beginning of the year, we were strongly positive, and then emerging market investment grade credit, we also had a positive position on there. And then when it came to the currency, we were quite positive on the rand in relation to the dollar. Now, what's quite common amongst SA assets is that we've got this really positive valuations point of view. So SA assets are cheap, it's quite attractive. But at the beginning of the year, what also was quite prominent is that sentiment was also pushing this view into a positive stance. And if we go into that, you can see that we had positive business sentiment, positive consumer sentiment. And if we look globally, global consumer sentiment and business sentiment was also positive. So all in all, from a sentiment point of view, that was definitely a theme. Now looking more globally, we can look at US equities. US equities were neutral in January. Now, if we look a couple months back, it was actually pretty negative, and that's because valuations were overextended and we did have quite tight monetary policy in place. But now what we can see is that it had moved to neutral. And why is that? Well, it's because at the beginning of the year, we had growth come online. So we had this very positive economic picture, and you can see the Prescient economic indicator was very dark blue. And we also had, as I mentioned before, positive sentiment, despite having very overvalued US equities. Now, what follows from that pretty rosy growth picture was the view on US sovereign bonds. So In January, we were quite negative here, and that's because US bonds are typically a safe haven asset. It's usually in a crisis scenario that this asset class starts to become a little bit more attractive. So if we're standing at today, what you can see is that it's still pretty neutral. It's actually a bit of a mixed bag. You can see that in the SA space, we're still positive on SA equities, but we're now also quite positive on SA bonds. Now, if we click into that and see what's driving it, it really is valuations. And if we go even further, you can see that SA real yields have been very attractive. Currently, they're trading around 5.3%. And then on the relative yield basis, even though US bonds were typically trading higher than usual, SA bonds still came up on top, which definitely helped this scenario. And then lastly, the term premium got even more positive. So investors were being rewarded for taking on this extra duration. But what did change was economics. So when we look at SA bonds and we look at economics, we actually look at global growth here because we find it quite informative for this asset class. And you can see that it's now moved to neutral. Where you can see this as well is in US equities, and you can see that the view has moved from neutral to moderately negative. And why is that? It's because economics has now become a little less promising. So going into this Prescient economic indicator that Bastian had taken us through, you can see that it went from being very dark blue at the beginning of the year to now very bright red. So definitely a slowdown in growth, which is a headwind for an asset like US equities. Then you can also see that sentiment had also moderated, being very driven by consumer sentiment that was negative. When we have negative growth, we know that it's not necessarily a crisis scenario this time around, but it definitely prompts us to look at US sovereign bonds more. Lastly, on the Rand, we sit at moderately positive, as we did at the beginning of the year. But what's driving this asset class is really the valuations again. Having a very positive real interest rate differential between South Africa and the United States, it provides a nice tailwind for this asset class. So borrowing at low rates in the US and investing in quite attractive rates here in South Africa, that is great for an asset class like the Rand.
Thanks, Shriya, for that detailed explanation. I mean, what it really does describe is that there are lots of moving parts. So I guess, from a portfolio construction point of view, you'd set your strategic long-term asset allocation, but with all these movements that can happen, you will tilt around the TAA, or the tilts that you'll make in the portfolio to take advantage. Maybe just talk a little bit about that for us.
Yeah, sure, Murray, you're spot on. We don't just create these views and do nothing with them. We actually translate it into the positioning. So as you mentioned, we focus a lot on our SAA in the long term. So that's typically where we'd be positioned for the next 30 years. And if we had a view, like I showed you, that was neutral, that would mean we're exactly at the SAA. What we then would do, wherever you saw us, having some positive positions or negative positions, we'd then put on exposure and take away exposure. But we don't just take the exposure down to zero if it's negative or very negative. And I think that's quite important, is that it's very marginal to take advantage of those shorter term market dislocations. And also because we are very set on selling a fund that is exactly what we say it is. So targeting a CPI plus 6%, in our balanced fund, you need to have a strategic asset allocation as it is, but it does have room to maneuver, and that's exactly what we'll do with our tactical asset allocation.
Romeo, Shriya covered the broad asset classes, but maybe if you don't mind, dig into a little bit into the equity market, and what did we see over the last quarter, and how does equity markets played out?
Thanks, Murray. So Shriya mentioned that we use a plethora of asset classes or factors to inform our asset class views. And SA equities were strongly positive at the start of the year, but now are moderately positive. And the reason for that was that sentiment has deteriorated due to various reasons, such as the Trump tariff and maybe some local sentiment. But valuations have also come in slightly because of the strong equity market rally. So that has resulted in a movement from strongly positive to moderately positive. In the US, we saw that we had a neutral view as valuations were unattractive, but sentiment and economics were slightly positive. Now that has now moderated to moderately negative because sentiment and economics have come in whilst valuations have remained unattractive. And to go in a little bit more detail, let's look at the SA equity asset class view. So if we look at the SA asset class view on a whole, we can see that we are moderately positive. This is comprised of the 4 different categories: valuations, which are currently strongly positive; economics, which are moderately positive; financial conditions, which are neutral; and sentiment, which is neutral. I really want to zoom in and focus on valuations, as it's the key driver of the asset class view at present. So if we look at valuations, we have 4 different metrics that we use to build up the valuation view: price to earnings, price to books, price to sale, and relative earnings yield. And if we go into one of these, which is price to earnings is the price you pay for every rand earned. And we can see that since 2021, SA Equities has been below its median long-term price to earnings ratio, which tells us that it is still attractive. There's still value in the SA market. When you look at this compared to the US equities are far above their long-term median. They're currently sitting at 24 for every rand of earning. And there may be a view that emerging markets are relatively cheap. This is not true, because emerging market PEs on a whole are higher than their long-term median. So to summarize all of this, we see that SA equities are cheap relative to US equities, but they're also cheap relative to emerging market equities and their long-term median. So there is a good case for the strong valuations of SA equities.
Romeo, thanks for that deep dive. Tell us a little bit about the performance that we experienced through Q1.
So global markets are a mixed bag in Q1, with developed markets underperforming their emerging market peers. And this was largely driven by US equities, which was down 4.3% for the quarter. And despite strong corporate earnings, we saw that the looming fears of the potential trade war from the tariffs that resulted in the US market underperforming. There's also looming concerns over economic prospects, as there's a potential for higher prices as well as higher interest rates. And we saw in March the S&P had its worst month in over 2 years. When we come to South Africa, we saw that despite the widening of the cracks in the GNU with regards to the fiscal framework and monetary policy, the SA equity market rallied as evaluations remain strong and supportive. The JSE All-Share Index is up 6% for Q1. That's largely driven by resources, which are up 30%. And the resources return were strongly contributed by the gold mining companies, because most of the gold miners were up over 80% in Q1. That's almost double your money. And the reason for this is that in volatile market conditions, we see that investors flock to safe haven assets, which gold is one of them that has been viewed as a safe haven asset for a century now. And the question often comes is, SA equities has rallied so much, but will this continue? And we can see that valuations remain strong, and although sentiment has come in, if there's an improvement in sentiment and financial market conditions, we can't see why we can't reach further highs.
Thanks for that review, Romeo. Bastian, there's a lot on the horizon that one needs to consider. I mean, if you think about what we've spoken to, you've had equity markets over the period in the US that came under significant pressure. You had the bond yields in the US rising. You had the dollar coming under pressure. I mean, there's lots to consider here. You know, from a portfolio construction point of view, as the CIO, what do you need to consider in this environment?
Yeah, we've spoken about it a lot already, and I think the core principle is always to measure scientifically what really drives capital markets and asset classes in particular. And if we do that, some of the topics we are spoken about are not all that important, and those are the topics which catch the headlines. It's a fall apart of the government of national unity, it's maybe political instability or the poor fiscal situation. That's actually not what really keeps us up at night. What keeps us up at night is more the global factors, because those we can measure that and show it. Those are really the driving forces, and there's obviously a lot of going on with tariffs and a lot of headlines around that as well. But our take is that the tariffs ultimately will lead to a short-term inflation shock, which we're not too worried about. And after that, the tariffs will actually have a deflationary impact, because it will mean less economic growth and with that, less inflation, and demand-side driven inflation will just greater, so to say. And with that, we are worried, and that's probably the biggest risk in our opinion, that the tariff story goes on, sentiment keeps on performing poorly, yet financial conditions remain tight because the Fed is not willing to move and doesn't really look through the short-term noise. So that's what really we would measure as the biggest risk, like weaker economics based on poor sentiment crisis intensifies, yet the Fed would not react, and those factors will be particularly poor. I'm not saying that's our base case. I'm not saying that's going to happen. It sounds like the tariffs are coming off again, and maybe entirely, who knows? But that's certainly one of the core risks to watch out for, way more than the local factors which keep on catching some of the headlines.
Thanks. I mean, you talk a lot about what's been going on. There has been a lot of noise. So one wouldn't want to just arbitrarily react to all of this. So you mentioned the systematic approach and really interrogating the data, which is important. Shriya, that comes back to what we spoke about just now around volatility. How do you take advantage of these market opportunities? What tools do you have at your disposal to make sure that you can protect your portfolio or take the opportunities as they arise?
I think that's a really good question, Murray. I think as investors, you've got lots of options and you could do many things. I mean, the first thing you could do is do nothing. So you could just, hold your strategic position for the longest time. But that's not something that we do. We're definitely quite active and we will take advantage of opportunities when they present themselves. You could de-risk your portfolio, so you could maybe move down the efficient frontier, take on less risk. But as I mentioned before, if in our balance fund we target CPI plus 6%, so we need to take on a certain amount of risk to get to that return. And then the last thing that you can do is think about diversifying. I mean, that's probably what's front of everyone's mind right now, is to diversify as much as possible. And that's exactly what we do. So as you know, we don't pick single stocks. We like to be in the broad-based indices, offshore in MSCI emerging markets, MSCI world, and that's worked really well for us. The only problem is that if you are going more offshore and diversifying more offshore, you have to take into account the currency risk, and that's something that a lot of investors often overlook. So what we do is that we put on protection for the rand. We currency hedge using futures, and we put on protection using option structures, depending on the mandate in the portfolio. So strategically, in our balance fund, we've got a 17% hedge, and in our defensive fund, because it's more defensive, of course, we have a 27% structural hedge. So that means that because the rand is so volatile, we want to ensure that if the rand unexpectedly strengthens, as it's done now, as it's done last year, post GNU, we are protecting our offshore investments. Because when you invest offshore, I know we've talked about it a lot in previous webinars, but you're getting the return of the asset class, but you're also getting the return of the currency, and you need to be able to protect that currency return. So we model the depreciation of the rand against the dollar at 4%. We're able to lock that in, and we're able to actually adjust that hedge because it's informed by our rand view that I showed you previously. So it's quite dynamic in its nature, but we're very comfortable with having a structural hedge in the portfolio. It's what we have modeled to be optimal in the long term. I guess then what the question would be is, well, what if the rand weakens more than 4%? And that's exactly why we don't hedge the entire currency exposure. So we see currency as its own asset class, and the rest that's unhedged will definitely benefit from that.
Thanks. I mean, fairly detailed and complex, but the point you make is that a mandate such as the Balanced Fund is looking to deliver a particular CPI plus return over time. And for investors, what they don't want to see is you retracting into, say, cash or even going riskier than CPI plus 6. So those long-term strategic allocations are important, and one can ride through the cycle to deliver ultimately the portfolio return that one's looking for. And we must always think about this from a construction perspective, because clients often blend more than one fund in a portfolio. You don't have to be second guessing your balance fund manager all the time. Okay, so thanks for that. Romeo, back to you, talking about risk, and particularly the Prescient equity fund. So there we deploy a portable alpha strategy. How does this unfold in these recent market conditions?
So portable alpha is beautifully designed whereby the beta component of the portfolio and the alpha components are uncorrelated. And the beta portfolio is obtained through the cost-efficient use of equity market derivatives, whereas the alpha component is invested in the cash and income space that we know historically is best suited to deliver outperformance. And the lack of correlation between these asset classes is quite useful and beneficial for investors. And we saw this in the first week of April, where equity markets were swinging all over the place. The strategy was able to still deliver outperformance. And what it just means is that you have alpha that can protect you. Alpha is invested in a way that it is able to protect you when equity markets are underperforming significantly. And I want to emphasize that in volatile markets, we remain active. We are active and we remain active. And our alpha engine, which we invest a lot of resources into, is able to respond in these volatile markets.
So you're actually getting a bit of the best of both worlds there. You're getting your equity exposure, but it's not just simply a passive exposure to the equities. As you're saying, you've got an active overlay, which helps in times of market volatility or downside volatility. So that's an added benefit. Shriya, just how does this approach translate into the performance of the balance fund? Because obviously you incorporate a large element of this equity exposure to achieve that CPI plus target.
Yeah, for sure. I mean, in the multi-asset space, we've got three sources of alpha drivers. The first is our strategic asset allocation, then it's our tactical asset allocation, and then it's our uncorrelated source of alpha, it's our portable alpha. So you take those three and then you combine it with competitive fees, and you get a performance that you can be proud of. I think this year, what I must mention and what came to light is the importance of having a stable process and having a process that can guide you through volatile times and times of uncertainty. And that's essentially what we do, being a systematic house. That's what you focus on every single day. So that definitely guided us, and the performance speaks for itself. We're ahead of the peer group in the balanced and defensive space, and we're sitting in the top quartile in the balanced fund over a 1 year rolling period. So we're really proud of how the strategy is done, and we're quite confident that it can guide us through any type of market scenario.
Thanks, Shriya. Yeah, I mean, the performance over the last year looks exceptional, and I think the point that you make there is the systematic rules-based process that we manage is tried and tested, and one sticks to that, or the team sticks to it. But maybe give us a view of how that's played out over the last few years.
Sure, because we are long-term investors after all, so let's have a look. So what we're seeing here is the proportion of time that's spent in each quartile over various rolling periods for the Prescient Balanced Fund. Now, if we just focus on the dark blue block, that's showing us the proportion of time spent in the top quartile. What you can see over time is that this dark blue block starts to grow as we extend the time period. And that's exactly what we try to do with this fund. We try and capture small amounts of alpha over short-term periods and believe in the power of compounding that will lead us to spending more time in the top quartile over longer periods of time. And you can see that over 10 years, we spent 100% of the time in the top quartile. So Mary, to answer your question, over the long term, the strategy definitely does work.
Thanks, Shriya. It's good to see that long-term performance chart. So thanks for digging into that. I mean, as I've mentioned, and we know well, is that one of the long-term drivers of performance for funds such as the Balanced Fund is obviously a large component of equity. So Romeo, how have the equity funds done?
So the equity funds have performed really well from both an absolute and a relative point of view. And as I mentioned, a lot of resources goes into our alpha engine, and it's quite nice to see that it's clearly delivering the outperformance to our clients. Before I go into the details of the equity fund performance, I want to remind investors that the equity fund, Prescient equity fund offering is not a passive tracker offering. Passive trackers although they have low fees, they're systematically set up to underperform the index. Whilst we, at a low fee of 30 basis points, we are able to outperform the index and deliver consistent outperformance over the long term. So let's take a look at one of the equity funds, the Prescient Core All Share Fund. If we look at this performance chart over the periods for the Prescient Core All Share Equity Fund, which is benchmarked against the the JSE All Share Index, we can see that the fund outperforms its benchmark over all time horizons. It also outperforms the ASISA equity category general. And I just want to focus in on the 1 year performance. We can see that the fund is outperforming its benchmark by over 3% and much more than the South African equity category general. And we want you to note that a passive tracker fund cannot deliver outperformance like this. And many fundamental managers would struggle. In fact, more than 80% of fundamental managers underperform their benchmarks over the long term. If we look at the quartile analysis, it beautifully demonstrates the power of this strategy, because we see that in the early periods over 3-month quartiles, the fund spends time in the different quartiles, top, second, third, and bottom quartile. But as we move to longer time horizons, which is well associated with the investment time horizon of equity investors, as we get into the 5-year periods, we can see the fund spends its entire time in the top quartile. So those gradual amounts of alpha year on year may not seem very large in a small period of time, but as you compound over long periods of time, you see that it delivers outperformance that's phenomenal. To demonstrate the strength of the Prescient equity offering, I want to turn your attention to the Prescient Equity Fund, which is a peer cognizant fund. But first, we want to look at the different South African indices. So we have the JSE All Share Index, which did about 22%. And the other South African indices like the SWIX and the Cap SWIX are all in that ballpark. If we look at how the peers in the ASISA equity category general have performed, they've significantly underperformed the index by more than 5%. The Prescient Equity Fund has delivered significant outperformance, not only against its benchmark, the peer group, but also to the South African all the different major South African indices, which speaks volumes about the power of the Prescient equity strategy. So, as you've seen that the Prescient equity funds have really delivered on what's on the box, and it's quite compelling to see that the peers are so far behind the average equity market indices, and it just speaks to the fact that, as I said, more than 80% of fund managers are underperforming their benchmarks over the long term. And our process can consistently deliver outperformance, not just in the short run, but also over the long term.
Thanks, Romeo. I mean, you unpack the drivers of that performance being the portable alpha, a fund that's well priced, and obviously the consistency of that over time is what benefits investors. So that's on the domestic side. We've also got funds in the international space. Maybe just cover those if you don't mind quickly.
Yeah, so the Prescient equity fund offering extends far beyond just what is offered locally. In addition to the funds I've showed, we also have the Prescient Equity Property Fund, which allows investors to get exposure to the property market. But speaking about global, there is both the developed markets and emerging market exposures. The Prescient Core Global Equity Fund is benchmarked against the MSCI World, which is a developed market index, and the Prescient Core Global Emerging Markets Fund is benchmarked against the MSCI Emerging Markets Fund. And the same portable alpha strategy that's applied locally is also applied globally. And what is key is if investors wanted to build their own MSCI all country index, they can just blend our funds at their will. And it just shows how holistic the Prescient equity strategy is and product offering.
Yeah, thank you. I mean, I think very applicable given that we know lots of investors in South Africa are taking money offshore. So again, from the Prescient stable, they've got options in the equity space. And particularly given what we see in the S&P 500, I'm sure there's lots of people making decisions around the long-term strategic allocation to just the US market. So nice to have that diversification option. And as you note, again, well priced. And of course, with the portable alpha engine as an overlay. So again, consistency that we'd expect from the Prescient funds offshore, given the process is replicable, runs on a formula, and that the portable alpha engine is there to benefit clients as well. Folks, I think we've come to the end, but before we do that, Bastian, let's just recap. We've been through some significant sort of volatility given the Trump tariffs and where we are now. What comes next?
Yeah, that's a good question. We don't have the crystal ball with us today, Murray, but I guess an important point was made on the risks. like there is a lot of uncertainty out there. We must not focus on the headlines. We must look beyond the headlines, focus on the true drivers of asset class returns. I think Shriya covered quite a few of those, looking into valuation metrics, market sentiment metrics, economics and financial conditions. Those will remain the drivers, and that's what we will keep on focusing on. If we do that, what does stand out is that South African assets are more undervalued than global assets, or are undervalued. Global assets are, as we think, overvalued. From an overall TAA point of view, we take a quite cautious stance, so moderately cautious on most of the risky asset classes, with a strong exception being that we do like the South African asset classes, where we're mostly positive. Having said that, diversification is key, and that is ever more important. We could see it all of a sudden, those amazing US Treasuries behave like a risky asset, and we hold US Treasuries, and we should. But we also hold some alternatives, like our high yield credit fund, like our clean energy fund, like maybe even infrastructure debt fund, and those have proven themselves as true diversifiers, so don't forget about those. So in the balance fund we get all of those, and then one core engine room is obviously at our alpha process. The heart of our alpha process is portable alpha, and I think Romeo has taken that into the last detail, showcasing that while active asset management is tough, he speaks about 80%, and that's spot on. 80% of the managers don't get it right, yet with our engine room you get it consistently ahead a little bit, and then obviously the gap just keeps on opening, and that's what we can see in the equity funds and our balanced fund and across our fund.
Lovely. Bastian, thanks. Shriya, it's all about getting the asset allocation right. I mean, you've demonstrated that in the performance of the balanced fund over the long term. Again, Romeo, also on the equity side, it's about getting it right. But you know, we've spoken about what gives you the benefit in that space. And I think for investors, we've got you know, the best of both worlds here. For those that like to allocate to a balanced fund in portfolios where you don't want to make the strategic or tactical asset allocation calls, as well as for those clients that want the building blocks, we've got the equity portfolios, both domestic and offshore. Thanks very much, folks, and that's a wrap for our multi-asset and equity review this quarter.